Hi everyone, it's Grace. Welcome back to my channel. We're almost at the end of 2022 and ushering 2023. So we're halfway through the recession. And today I'm going to update a very important charts that include 5 of the most important interest rates that will give you a lot of technical guides. All right, so for today's topic, I'm going to focus on how you can use the upcoming recession to get rich. All right, there's a lot of technical stuff to go through today, but I will make it as simple as possible. All right, so before we begin today's video, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. And please also consider contributing to my channel, whether through PayPal, Cash App, Zelle, or QuickPay. And I'll provide the links in the link tree in the description down below. Thank you so much for your support. And in the past videos, I've also made topics regarding to whether there are opportunities and risk in a recession, and also why I think that the pandemic boom is over. So make sure that to check out here for that video. The first thing that I want to share with you is the Fannie Mae consumer confidence. It's actually related to how consumers think about the housing market and also the economy as a whole. So as you can see here, as high as 75% of the consumers think that it's a very bad time to purchase a home right now. And that percentage has increased to 80%. And I totally get it because there are two unaffordability reasons. The first thing is that housing prices are still very high, even though in some areas it's crashing down. And the other thing is that the fixed mortgage rate, especially the 30-year fixed mortgage rate, is close to 7%. And it's just ridiculous. If you think about a year ago, it was only at 3%. So that's like more than doubled. And just think about like how much more interest you're going to pay if you really purchased a home at 20%, right? So, and also this type of percentage is also very interesting. So the people who think that it's a very bad time to sell also increased from 33% to 42%. So one of the most important reasons why sellers are not willing to sell at such a time is because they will lose a lot of equity values if you sell. When you know that the mortgage rate is shooting up the sky, and also the inventory is also increasing like really quickly. So why am I showing this consumer confidence to you is because people's expectation of the market actually has a very huge impact on how the market moves. So you should really keep in mind that this is a very special time and a highly volatile time. And I do think that stability is really important. All right. So the next thing that we're going to take a look at is the chart that I just compiled for today. All right. So I actually did a chart like this at the beginning of this year, which also shows you 5 of these most important interest rates. So just quickly go through what these interest rates means. So the baseline is the green line, which is the effective funds rate. So everything else actually gets built on top of it. So the next thing, the next curve that we're seeing is the 10-year Treasury security yield. So that is one of the most important things because the Fed actually uses it to adjust the market supply and demand of money, of the US dollar, and potentially also all the other currencies in the world. All right, so as you can see, these 3 lines, so the red line is the 5/1 year adjustable mortgage rate, and the blue line is the 15-year fixed mortgage rate, and also the yellow line is the 30-year fixed mortgage rate. All right, so right now, we're clearly here. And if you're comparing to the COVID situation, the COVID recession, right? And also the 2008 financial crisis, look at where we are right now. It's just crazy. In amount of like less than a year, we're already above the especially like when you're looking at the 30-year fixed mortgage rate, it's even higher than the peak point of 2007 and 2008. That's just crazy. So I do think that these exceptionally high interest rate is going to kill the US economy. Just think about it. How are people supposed to buy a home? a property for rental or whatever it is at such a high mortgage rate. It's just like impossible. Of course, for people who are willing to buy or are able to buy with all cash, they probably could. And they can potentially like ignore these factors. But the asset price is also coming down just because the interest rate is going up, right? So just think about like how much more impact it's going to be. Think about it. At the beginning of November, a lot of tech companies are actually having what I call a technical layoff. I don't think that it's fair to say that it's mass layoff because it's still like a percentage of its total workforce. If you don't consider some of the companies that are having revenue problems, I do think that it's more accurate to call it technical layoff. All right. So here is the most important thing that you need to understand from this chart. All right. So what I'm going to do is to only show you the rates that are most recent. So you have a better take a look at it. All right. So all these rates are going up. And in this type of situation, and I do think that it is important to make a forecast of what is going to happen for 23 and 24. All right. So if we look at the historical pattern, the highest interest rate since 2008 is actually around 5.3%. And right now, as of today, in November 27th, we are actually seeing that the Fed funds rate is at 3.83%. All right. So in the December FOMC meeting, what I think that the Fed will probably slow down a little bit from 75 basis point to 50 basis point. However, it's still a rate hike. So we're going to be above 4%. And the range of 3.75% to 4% is a very restrictive session. As we can see, the labor market is softening really, really quickly. And I do think that not only tech companies, but also the real economic companies are also going to have the technical layoff for the rest of 2022 and 23 as well. All right, so let's just zoom out to see the whole chart again. All right, so what you're seeing here is that from 2006 to 2007, we're seeing that the rate was paused around 5.3%. And I do think that in the first half of 2023, the Fed funds rate is going to be between 4.5 to 5.5%. If the Fed wishes to be a little bit hawkish, I do think that it's going to be higher than the level back in 2008. So we're looking at two totally different situations. So right now we're close to 4%. And in the middle of next year, we're going to be around 5%. And these two interest rates will provide a totally different economic environment. 5% is going to be very, very restrictive. It simply means that the housing inventory is going to is going to increase. It's going to increase a lot more than now. And then the asset prices, regardless of whether it's real estate, it's fixed income, bonds, equities, and obviously cryptocurrency is going to be slashed. All right. However, during that period, the asset value is not going to be like off the cliff type of situation. What it means is that it will have a gradual decrease to where, we're probably going to see the decrease of the asset value to be close to January 2020. So that was when, that was just before COVID hit the US economy. All right. I do think that all of the asset prices, especially real estate, is going to go back to that level. And that presents itself a great opportunity for potential buyers to be able to afford a home again. All right. So the next thing that I'm going to do is to provide a little bit more technical analysis regarding what the US economy is going to look like for the second half of 2023 and 24. I do think that we're going to have a pausing rate situation from the end of 2023 to 2024, right? So during this period of time, I think that the Fed funds rate is going to stay at that level between 5 to 5.5%. So it's going to be really, really restrictive. The good news is that the inflation represented by core PCE is going to gradually go down to 2%. I know that it takes some time for it to go there, but it's important to understand that it is going there because that is intended by the Fed. So if we're having this type of restrictive environment, the inflation is going down, and then the prices for everything is going to be affordable again. All right. So how are you going to use the type of situation to get rich, right? So the first thing that you need to understand is the position of your portfolio. Like how much percentage of each type of assets that you are holding right now. Obviously, it's not realistic to convert everything into cash. That's just not how things work. But you also have to understand what is the apparent risk for the next 2 years and what are some of the opportunities that you might miss out. So I want to share one of my favorite companies. So Airbnb actually factors very well. At the beginning of the COVID recession, it actually just laid off a proportion of its workforce. But during this time, it's not laying off anybody. And I think that that's a stable sign. For those of you who are not familiar with Airbnb, it actually started in 2007. All right. So when you're taking a look at this chart, it basically means that Airbnb started when there was a pause of the rate. So from the second half of 2023 to 2024, we will be expecting some tech startups and also in other industries that's going to have some kind of like outbreak, right? They're going to grow. They're going to have this exponential growth opportunity. So besides looking at this traditional asset valuations and performance, you should also take a look at some of these startups and find out some of the ways to put part of your money or part of your US dollars into those opportunities. For myself, I actually invested in Start Engine. So it's a platform for people to invest in pre-IPO startups, right? So you're holding those values there, and during this type of situation, they're able to capture that opportunity and grow very soon. So there are definitely both risk and opportunities. All right. So the next thing that I'm going to provide a little bit more analysis is the rate drop. So this is also a very important situation for you to understand what that means. So the rate drop also lasted, if we're looking at this chart for the 2008 financial crisis, it started from the end of 2007 to the end of 2008. Right? So it lasted about a year and a half. And I think that for the majority of, for 2023 and 24, the rates will not drop until the end of 2024. And it will probably also take a year and a half to drop to the bottom again. I do think that the Fed funds rate is going to drop to near zero again because that is a reliable historical trend. So what you want to do during this rate drop period is realizing that the equity market, meaning the stock market, and also the real estate market and also cryptocurrency are going to bottom out. This is the period when you want to go in, buy everything really, really cheap and make a lot of money. All right. But that period will not start until the end of 2024. And the rate drop period will probably last for a year and a half. Let's just be a little bit conservative and say that it's going to, the time when the Fed funds rate is going to hit near zero again is going to be 2026, in the middle of 2026. So that's when you're going to be able to purchase everything at a super low level price. So this is how you can actually have some kind of control, even though we know that like for individual investors or institutional investors, there's just no control over what the Fed will do next. All right, so now that we understand the situation a little bit better, so the rate pause is going to last from the middle of 2023 to the end of 2024. And the rate drop is probably going to start from the end of 2024 to the middle of 2026. So you have like a rough time frame of what it will be like. So prepare yourself for having enough liquidity, and also look out for some of the new opportunities. During this rate pause period, there are potentially startups just like Airbnb, Uber, or any other startups that will have exponential growth during this period. So this is pretty much today's video, and I hope that the technical analysis doesn't deter you away from watching my video. So make sure to check it out. And I'm also going to provide this chart on my website and also Tableau profile. So make sure to check them out as well. All right. Thank you so much for watching today's video, and I'll see you on the next one.